Greetings, and salutations. Good morning. It is 9 o'clock at night. Good morning, nonetheless. We are going to study Chapter 3, Section 2, Portfolio Management Styles / Techniques. A very interesting chapter. I do say so myself, and we're going to play some Fall Guys. Nothing too stressful, something light. Let's go ahead and start. We'll do some knockout. We're going to start with the first section, strategic and tactical asset allocation. The major decision to be made for a client is the allocation of portfolio assets between equity investments and interest-bearing investments. This decision will establish the basic risk, volatility of the return versus the rate of return, characteristics of the portfolio, balance between equities and debt. Thus, the portfolio needs to be balanced between interest-bearing and equity investments. The basic trade-off between the two types of investment is going to be followed up right now. This cowboy hat's kind of lit, if I do say so myself. It's too easy to get out of my way, bro. Oh, this is easy, Qual. This is so easy. So easy. No, don't even try that. You dumb motherfucker. Fucker made it? Good for him. Here we go. Get in my way. No. Paid my dues. I deserve this. Nobody on blue's gonna make it. Y'all are just missing the mark in life. Y'all are just, the brains are not working here, are they? Mother. Get the. Alright. Fantastic. Between the two types of investment is interest-bearing investments have lower credit risk and no volatility of return, which is good for fixed income investments, but the return is susceptible to market risk and purchasing power risk. Equity investments have higher credit risk and much greater volatility of return, but they have proven over time to be able to grow at a faster rate than inflation, building purchasing power. Thus, there is a classic trade-off between the two types of investments. Another factor to consider in balancing the portfolio is the investment time horizon. Are you looking to invest for 30 days or 30 years? What are we looking at here? A combination of the two or none of the above? I meant to do that, I meant to do that, I meant to do that, I meant to do this. I'm not even looking. My monitor's off for this one. It's so easy. So easy. I'm not gonna get touched. Can't even hear you back there. We're jumping. We're winning. We're winning. So annoying. You ugly skin having fuck. Long time horizon. Over the long term, inflation has proven to be the greatest risk, making equity investments the better choice for long time horizons. Short time horizon. Over the short term, equity returns can be much more volatile and can be negative as well, making interest-bearing securities the better vehicle for the short term. Liquidity needs. Another factor to consider in portfolio balancing is portfolio liquidity. A portion of the portfolio needs to remain liquid to meet anticipated cash needs. Asset classes: equities, fixed income, cash, real estate, commodities. We'll get into that in a bit. I don't even know what math this is. I'm gonna follow the arrows. It's usually a good idea in life. I meant to do that. Oh. Alright. We'll continue on. Asset classes, equities, fixed income, cash, real estate, commodities. Looking at the big picture, we have described 3 asset classes with different characteristics: stocks, bonds, and cash/money market instruments. In addition to these 3 asset classes, real estate and commodities are the other generally recognized asset classes. Within each asset class are investment vehicles that are a subset of that asset class. Okay. It's going to be an interesting read. Really bread and butter, nuts and bolts of what finance is really all about. Not all about, but a big portion of it. A basic portion of it that most people, probably don't get the information or education on. Granted, how would they? This is kind of gatekept by the industry, so it is what it is. And it ain't what it ain't. What are you doing, dude? What are you? You're gonna die. You're dying right now. You survived. Out of the skin of your ass. I'm dead. Can I make that jump? Oh, you're kidding, right? No. Hold on. Hold the phone. Wait, am I dead? Am I dead here? Wait. Okay. Don't stress out. Stay calm. Don't worry about that chicken. If you grab it, you grab it. If you don't, you don't. Even if they grab it, they can't hit you with it. What are they gonna do? Jump? Fall Guys chickens have verticals of 2 inches. What are you talking about? What are you stretching in the middle of the game for? Lock it in. One at a time. Here we go. One at a time. Here we go. Wait. Jump too early. It happens. We'll keep watching so I can read on. For example, growth stocks would be an investment vehicle within the equities asset class. Creating an investment portfolio consists of the following steps: selecting which asset classes will be represented in the portfolio, determining the target percentage of the portfolio to allocate to each asset class, specifying for each asset class the allowable range by which the allocation can be changed to take advantage of market conditions. Oh, dude, your skin sucks. It's so boring. Nobody cares. Selection of the securities within each of the asset classes. The normal asset allocation is chosen by the manager based on the client's investment objectives and risk (volatility) tolerance of the customer. The quote-unquote traditional portfolio is one that consists of U.S. government treasury bills, long-term corporate bonds, and large company stocks. Thus, we have 2 asset classes in this portfolio: equities and fixed income. Have completed step 1 above. Strategic asset allocations. We're moving on to the next section. Step 2 is the process of selecting a target asset allocation. That is the proportion to be invested in different types of securities. This is also called a strategic asset allocation. Let's assume that we choose the following target asset allocation: U.S. government T-bills at 20%, long-term corporate bonds at 30%, and large company stocks at 50%. The proportion of assets of each investment vehicle is termed the portfolio balance, or the normal asset allocation. In this beginning example, we have used only 3 investment vehicles, but we can use many more. This will be illustrated later. Sure it will. Large company stocks. Think Apple, Google, Meta. I mean, any company that sells any Coca-Cola, Pepsi, Target, Costco, Starbucks. Alright, let's do this thing. Dude, get off me. You're not even in my league. You're not even in the draft. Oh, it's on such a roll. Come on. That's me. Really? Wow. Whatever. The target weights chosen will depend on the customer's investment objective, time horizon, risk tolerance. The overriding objective in such an allocation is to achieve the highest expected return versus volatility assumed by the client. Tactical asset allocation, next section. Step 3 is where minimum and maximum limits are set for each investment vehicle's portfolio proportions. This allows the portfolio manager to take advantage of market conditions within the parameters set by the minimum and maximum percentages. In essence, this is the market timing aspect of the model. If conditions favor one asset class over another, the manager can, quote-unquote, time the market within the allowed percentages. For example, assume that we set the following, quote-unquote, tactical limits for our portfolio. U.S. government T-bills, 20% target, a 5% minimum, and a 50% maximum. Corporate bonds at a 30% target, a 10% minimum, and a 50% maximum. And large company stocks at a 50% target, a 25% minimum, and a 75% maximum. The idea behind the tactical minimum and max percentages is that it allows the manager to shift portfolio emphasis based upon market conditions. For example, in this case, if equities are performing strongly, the manager may shift the portfolio to 60% equities from the target 50%, while, say, reducing corporate bonds from the target 30% to 20%, but it precludes the manager from betting the ranch on, say, 100% equities and running the risk that was the wrong bet. Okay, so you set your parameters. As a client, you let them know what you will take on, what you won't take on. Fair enough. I don't think I win here, because Alright, let's try this. Yeah, I can imagine that everybody sees that the equity market's going up and they all want a taste. And you want to ride the wave and assure that, people are in the market. You want to get a part of that too. Probably lower your corporate bond exposure, your T-bill exposure to a degree. Are you kidding me? There we go. Dynamic asset allocation. Another name for tactical asset allocation is dynamic asset allocation because it allows a manager to dynamically overweight asset classes that the manager believes will outperform and underweight asset classes that the manager believes will underperform. Step 4 is the actual selection of the securities to be purchased in each asset class. The actual selection can either be done in an active manner or a passive manner. Active asset management will be the next section. Active asset management, I'm assuming that's like continuous buying and selling of securities, which according to the literature, is not the most viable strategy. Wait, okay. What's up, dude? You dick. You absolute dick. Thanks for that. Thanks for that. I really needed that. Money makes the world go around. Get off me, dude. There we go. I might have died if I lasted a second longer. Active asset allocation is based on the belief that fundamental analysis performed by the analyst can identify undervalued securities and produce a superior return within the asset class. In essence, such a strategy seeks to find inefficiencies in market pricing of specific securities. This is an expensive process, and the cost of the process must be exceeded by any incremental return achieved. And I have an annotation here. It says it is a B word of a process, and it really is. I mean, you have to go through company balance sheets, you have to go through their SEC filings, you have to go through their 10Ks, their 10Qs, see what it is that they have going on. A very interesting process, a great process to learn about business in general, but in terms of asset allocation and being a fund manager or being an advisor, it's not exactly the most efficient way of working. It's a very 1980s way of working, but I think it's still important because you get to see, important things about a company that you typically wouldn't see, right? Are they taking stupid bets? Where are they putting their money? Do they have any legislative problems? Their executive board, what are they about? Are they a cash company or do they just have good numbers on the balance sheet? There's a difference. So there's a lot of different things. You get to see some of their plans, right? Where they're looking to fund their initiatives, where they're looking to expand, where they're looking to contract a little bit. It all works out, and I think it's useful. Wasn't really looking. Let's continue reading on. Passive asset management. Passive asset selection is based on the belief that the market is efficient in pricing securities, and that an index fund can be used for each asset class, giving desired diversification with minimum annual expenses. Most people erroneously believe that the most important step to the investment process is step 4, the selection of the specific securities in the portfolio. However, studies over time have shown again and again that the most important steps are 1 and 2. The primary determinant of investment performance over time is asset allocation. Market timing and security selection have shown to be very little to do with the long-term return of the portfolio. This is a very strong argument for index funds, by the way. Okay. Makes sense. And I kind of believe it too. I mean, if you really do try to time the market and try to get the right stocks, you're going to go crazy. The time you spend, the hours you spend, you're at a loss essentially 90% of the time. And that 10% of the time where you do win, it's really not worth it because it doesn't cover much. You're lucky to get a penny out of the market. In my opinion, I think so. So yeah, I agree. It's a very strong case for index fund investing. Let your money work for you, so to speak. The next section will be investment vehicles. I'll read a few sentences. If we believe that the most important steps in the process, I'm not even going to read that yet. Focus on the game. Lock it in before I can lock it in. Get off me, dude. Yup. 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 Hey. 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 Here we go. Here we go. Here we go. Here we go. Hey. Hey. Hey, fella. Hey. Take a Larry. Here we go. Here we go. Here we go. Yup. If we believe that the most important steps in the process are asset allocation, asset class selection, and strategic balancing of each class, then the full range of asset classes should be considered when creating a portfolio in order of increasing risk, standard deviation of returns, and rate of return over long time periods. These investment vehicles are treasury bills, treasury/agency bonds, international bonds, large capitalization stocks, mid capitalization stocks, small capitalization stocks, international stocks, REITs, real estate investment trusts, micro capitalization stocks last. In addition, subsets of each of these can be created. For example, international bonds could be broken out into developed country debt and third world country debt with different risk return characteristics. Okay, that makes sense. It's funny how they put micro cap stocks. That basically penny stocks, and a big reason for that would just be, I assume, the ability to manipulate the stuff, because they are such low value that it doesn't take much, money, supply and demand, so to speak, to shift the price a few pennies. But look at the Bitcoin craze. Look at the meme coin craze. All it takes is a few pennies to make you a lot of money. If it's trading at pennies on pennies on pennies on pennies on the dollar already. What the these fucking idiots. Dummies. Don't push it. Don't push it. Oh no. Here we go. Regarding market capitalization of stocks, the definition used by Standards & Poor are microcap, any company whose outstanding market capitalization is less than $250 million. A small cap, any company whose outstanding market capitalization is between $250 million and $2 billion. Mid-cap, any company whose outstanding market capitalization is between $2 billion and $10 billion. A large cap, any company whose outstanding market cap is between $10 billion and 200. Did I get that right? 200. It says 200 million, but that's a typo. To my understanding, silver. Oh, are you kidding me? Tiny this thing. Where'd it go? Here we go. That's mine. Oh, dude. It hit. Gotta give me some of these. It's me. fine. That's fine. Not angry at that. Just give me this silver. Nice. Yes, so large cap. Any company whose outstanding market cap is between 100 billion and 200 billion. A mega cap. Any company whose outstanding market capitalization is over $200 billion. Investors with low risk tolerance and or short time horizons would have portfolios weighted towards the upper part of the listing. Investors with high risk tolerance and or long time horizons would have their portfolio weighted towards the bottom portion of the listing. There are a number of well-known market indexes, and thus index funds, available for most of these categories. Among the more well-known indexes are the Dow Jones Industrial Average, consisting of 30 large cap issues, mainly New York Stock Exchange listed, with the makeup of these selections chosen to mirror the U.S. economy. Standard & Poor's 500 average, the S&P 500, consists of the 500 largest market capitalization issues of companies headquartered in the United States. Got it. Gotcha. Ooh, alright, so don't let this touch you, right? I can do that. Okay, I don't. Why am I nervous? Whoa! Whoa. Wait a minute. Fuck that guy. The Value Line Index, consisting of 1,700 stocks of companies listed on the New York Stock Exchange, the Amex, now renamed the New York Stock Exchange American, and the NASDAQ, are followed by the Value Line Investment Survey. This is mainly a large cap index. The Wilshire Index consists of all common issues listed on the New York Stock Exchange, the Amex, and NASDAQ, now about 3,500 stocks. But the number was closer to 5,000 stocks when the index was started in the 1970s. The Russell 2000 Index consists of 2,000 small capitalization issues, mainly over-the-counter issues. Really? I didn't know that. I don't know if the Russell was over-the-counter. Hold the phone. Smallest stocks in the Russell 2000 with a market. Oh wait, that's something else. Small cap company. Interesting. Okay. European Australasia. It actually says that Australasia. So Australia and Asia have teamed up together to create an index. What the No. That did not happen. I'm not missing something here, right? Wait. Will Patrick Star get the fuck out of my way? I'm a big fan and all, but come on. Let me show them how it's done. Wait. Try again, take two. Let me show them how it's done. Okay. I'm not even looking on this one. Wait, I can actually make that. Gotta focus a little more here, but oh, goddamn. Alright, stop fucking around. Alright. European Australasia Far East EAFE Index consists of the largest stocks by market capitalization of companies based outside of North America. It is the oldest international stock index, starting in 1969. In addition, there are less commonly known indexes, such as the S&P's Midcap Index, mirror the above category. Investment policy statement. I've seen this before. Once the proper portfolio composition is selected, this is documented in a statement of investment policy. Such an investment policy statement is used to give the customer, in writing, a summary of what can be expected from the strategy chosen. Below is an example of an investment policy statement for a customer who is risk averse. And it shows a little illustration here. It says investment policy statement, parentheses, low volatility portfolio. Long-term portfolio balance of 50% in the money market instruments, 25% in long-term government bonds, and 25% in large cap stocks. Okay, so this person is a little more, deep into their life. Obviously, large caps at 25%. Is very telling. Investment portfolio benchmark, 7% expected return with a typical yearly range of results from 2% to 14%. Alright, I'm going to finish this off before I keep reading. I like this section. I mean, not that I don't like any other section, but this is kind of the nuts and bolts of why I got into the business, to a degree. You want to make sure people are, being taken care of financially and not getting royally screwed out of their dollar bills, Alright, 24% on the first run. That's not great. %58% second run. Not great, dude. God, come on. All right, this has to be my run. Has to be my run. Gosh, I need this. 86%, not great. Come on, it's gonna fill up quick. Get out of my way. Get out of my way. Are you kidding me? I need this. I need this. One more. Oh, you're not a chance, right? I need this. Dude. Oh, no way. No way, this is how I go out. Got it. And at the bottom of the investment policy statement, you have the benchmark portfolio returns. Expected return for Treasury bills at 5% with a standard deviation of 0%. Long-term government bonds of 7% expected return with a standard deviation of 6%. Large cap stocks with expected return of 13% with a standard deviation of 18%. So yeah, pretty heavily weighted towards the surefire returns. Portfolio rebalancing will be the next section. Once the portfolio is constructed, the next issue is that as the investments are held, the balances may shift due to the relative performance of each of the asset classes. Which makes sense. Stocks start moving up. Get the hell out of my dude. I hate these kinds of people. You know what? You want to play though? We'll play. I hope that dude dies. Where's that? Little bastard, huh? I'm wishing evil on him. I really am. He knows how to play that, and I don't, and I have to learn. That's what I thought. Where were we? To rebalance a portfolio is simple. Just reallocate money from the overperforming assets to those that are underperforming. For example, in a bull market, the equities will outperform other securities in the portfolio, and the equity portion will become larger than the target allocation. These must be sold to rebalance the portfolio, with the proceeds invested in the relatively underperforming bonds in the portfolio, which makes sense. Let's spectate our boy and see if he's got any skills. Buy and hold is the next section. Rebalancing should be done rather than simply buying and holding the original positions. If one were to buy and hold and the portfolio were to go through a bull market, then just as the bull market was ending, the portfolio would be at its maximum equity allocation, which is not where you want to be at the beginning of a bear market. Yep. Over the long haul, a buy and hold strategy will tend to this dude, this guy. He's skillful. I'll give him that. I give credit where credit is due. Mans is skillful. A buy and hold strategy will tend to increase the portion of the portfolio held in equities as a bear market is entered, and minimize the portion of the portfolio held in equities as bull market is entered. Minimize the portion of the portfolio held in equities as a bull market is entered. So their argument is that if you go through a bear market and you just bought and held the entire time, you never really, you suck, dude. You never really rebalanced. You never bought more. You never sold off your bonds that were performing well to get into the, stocks. Okay, then I see what they're saying. The bull market you enter could have been at a much better situation, a lot more could have been allocated to your stocks, and yet you didn't do that. Okay. Thus, buy and hold over the long term puts the portfolio in the worst possible position, so rebalancing really is a necessity. Portfolio rebalancing can be done passively or actively. Really, passive portfolio rebalancing. Funds are continually reallocated from overperforming asset classes to underperforming asset classes to maintain the optimal target asset mix that has been previously chosen. Okay. So yeah, it just goes back to your original thought that, if you set a certain range for what you want in assets, you should stick to that range, and that should be your guiding light, so to speak. Active portfolio rebalancing. Funds are reallocated from underperforming or market performing asset classes to those that the manager believes will outperform the market over the coming time period. This is essentially tactical portfolio rebalancing and allows the manager an aspect of market timing. When rebalancing a portfolio, as with tactical asset allocations, minimum and maximum percentages are specified to prevent the too many eggs in one basket problem if a bet turns sour. That's a very smart thing to do. Always have your boundaries. with life, with money, anything. Have your boundaries. How much you're willing to take on and how much you're not. Those definitely count. Alright, let's call. Get out of my way. Get out of my way, dude. You don't even go here. You probably don't even read books, do you? Loser. Look at all these losers, dude. Look at them. Losers. Alright. Let's go to the next section. Section rotation. Sector rotation. A variation on active portfolio rebalancing is a sector rotation strategy. Sector rotation is based on the fact that as the economy moves through the business cycle, different business sectors tend to outperform at each phase of the business cycle. Looking at the exhibit above, as the economy is in the early phase of an economic expansion, technology stocks tend to outperform the market. In the middle phase of an economic expansion, industrial stocks tend to outperform, while in the late phase of an... The hell is squeaking? Oh, that's my headphone jack. While in the late phase of an economic expansion, consumer goods stocks tend to outperform. Once the economy has peaked and starts entering a recessionary phase, telecom and utility stocks tend to outperform, and in the late phase of a recession, financial stocks tend to outperform. Oh, we're playing. That makes sense. Late in the stages of an expansion, people have to start paying their debts with the writing on the wall that money's not going to keep coming in forever. So they have to, get stuff out now. Watch out for these guys. They're going to try to push. Don't. Any cannons here? No cannons. Makes sense. Yeah, dino dick. Fuck off. But to be honest, who's to say when an economic expansion is, taking over versus when it's, when it's slowing down, Obviously you can read into the data, but data can change. If the Federal Reserve really wanted to, they can just lower the rate, raise the rates. Things change. Things always change, and the economic expansion takes a long time to get there. Nice. Continuing on. A sector rotation rebalancing strategy is based on this theory and overweights the outperforming stock groups based on the phase of the business cycle. Regarding the selection of securities from step 4, there are additional factors to be considered. Let's go back to the target asset allocation shown earlier. U.S. government T-bills at 20%, a long-term corporate bond section at 30%, and a large corporate stock section at 50%. If we were to invest 50% of the funding in the common stock of one company, say IBM, this would fulfill the requirement to have 50% of the portfolio in large company stocks. However, the level of non-systemic risk of this position is high relative to the expected return. If, for whatever reason, IBM turns into a bad investment choice, the overall return of the portfolio would be diminished for years to come. Which makes sense, yeah. I'm assuming their point here is just avoid the all your eggs in one basket problem, where you just, don't be stupid with it. I mean, you should kind of know that stocks are not guaranteed. Things do happen. Slowdowns can occur. Shocks do happen. People invest in stupid stuff that unfortunately is also tied to their net worth. People finance things based on debt, and come to find out when it's time for the chickens to come home to roost, they don't have the money to pay that off. Things happen. The next section will be diversification, but I'll try to win this one. I have been trying to win the other one, so let's see if I can try to win this one. From my understanding, this is not... What the They don't know I got this up my sleeve. Hey. Alright, well, tried my best. Diversification. Hence, the portion of funds invested in equities must be diversified, allocated amongst all types of equity investments. Thus, the 50% of assets might be spread as follows for an investor with a lower risk tolerance: large cap stocks at 20%, mid cap stocks at 10%, small cap stocks at 5%, international stocks at 5%, REITs, real estate investment trusts at 5%, micro cap stocks at 5% as well. For an investor with a higher risk tolerance, the allocation might be large cap stocks at 5%, mid cap stocks at 5%, small cap stocks, international stocks, REITs, and micro cap stocks all at 10%. Is that the avatar? Oh, that's badass. Oh, that's sick. Okay. All right. I give credit where credit is due. That is fucking sick. Okay. Through diversification, if any one sector gives lower than expected or negative returns, this will not impact the portfolio as strongly, and other sectors might perform better than expected to offset such an event. Okay, so I see their point. You spread your eggs across a few baskets, and whatever basket performs well, based on whatever objectives you have, you can rebalance based on that. Which is a good strategy to have, but with the same token, it does seem like a bit costly, because everybody's not going to have the time, which is why you get a financial advisor, right? Indexing tracking error. Another factor in step 4, security selection, is the use of indexed securities. I'm seeing that they're putting this step 4, security selection. So step 4, making a note here. Selection. Making a note just because they keep putting it in parentheses like it's an important aspect. Typically when you see patterns like that in a book, good to follow them. You never know. You dicks. Let's go. Cool. Another factor in step 4, security selection, is the use of indexed securities. This gives built-in diversification by simply buying index fund shares that match the asset classes selected. For example, there are Standard & Poor's 500 index funds available, as well as Standard & Poor's 400 mid-cap funds and Standard & Poor's 250 small-cap funds. Index fund managers who seek to match the performance of a benchmark index must in reality do better than the benchmark index results to cover the costs of operating the fund, for example, brokerage costs, administrative costs, etc. They cannot be completely passive in their approach because then they will always underperform the index or the tracking error. Okay. Kind of see what they're saying. Have to make up for the costs of getting in and out of the trades, because you can buy an index, but the index itself is not, set in stone. It's tracking an index. The index tracks an index, right? An ETF tracks an index. That's what I'm getting at, if that makes sense. Two separate things. Only 6 to go. Oh, I remember this game, I think. Okay, so that. Damn. Dude. Come on. Don't let me down. Damn. Oh, there we go. All right. I feel it coming. Damn. Dude, get out of my way. Oh, dude, this is an L. This is an L. Damn. Yeah. I need more practice on this map. Need a lot more practice on this map. We'll keep watching. More time to read. Yay. Index fund managers mainly employ passive management, but also use active management to reduce the tracking error. Therefore, in order to boost their yield to cover these expenses, they must employ a bit of active asset management. In essence, making disproportionately large bets on stocks in the index that they think will outperform the index, in order to juice up their returns enough to cover fund expenses. The idea is that the positive tracking error from actively managed positions will more than offset the negative tracking error built into the passively managed position. Okay, so they want to outperform even by a little, just to be able to cover their expenses and in essence match what it is that the actual index was tracking. Yeah, that makes sense. There's a business around that. I get that. Financial leverage. Another way for an asset manager to boost an investment return is through the use of leverage. This is the use of borrowed funds to increase the dollar amount invested. As long as the funds can be borrowed at a lower interest rate than the return on the investment made with the borrowed funds, this is a profitable strategy. Positive financial leverage. For example, if funds can be borrowed at 4% and then used to make an investment yielding 5%, there's a 1% positive financial leverage. Negative financial leverage. On the other hand, if the cost of borrowing is more than the return of the investment, for example, borrowing money at 5% to make an investment yielding 4%, this is a 1% negative financial leverage, and the investment would not be made. Bond portfolio immunization. Portfolio immunization is the strategy of managing a portfolio to make it worth a specific amount at a stated date in the future. This strategy is typically used to fund a known future liability. For example, assume that a customer needs $50,000 in 10 years. If the customer buys a safe 10-year, zero coupon obligation with $50,000, with a $50,000 face amount, such as treasury strips, then the customer will have the needed principal amount 10 years from now. The intent of bond portfolio immunization is to eliminate interest rate risk. If the customer were to buy, say, a conventional 30-year treasury bond to pay off its liability in 10 years, the interest rate rose substantially. In the meantime, those bonds would drop in value, and the needed funds would not be there in 10 years. Well, yeah, that's kind of given, right? It's a 30-year thing. It's like saying you're going to invest in stocks today to pay off, a big expense tomorrow. That's a bet. And that time horizon is just a bad bet along with it. The intent of bond portfolio. Okay, wait, we already got that. The bottom line is that to immunize a portfolio, the duration of the bonds used to fund the future liability must match the length of time until the liability must be paid. Yeah, that makes sense. Bond contingent portfolio immunization. Do not confuse bond portfolio immunization with contingent bond portfolio immunization. Contingent bond portfolio immunization is an active management strategy where the manager attempts to select bonds that will outperform a benchmark index. But if the portfolio drops below a predetermined value, the manager shifts to a defensive strategy, buying top credit-rated bonds with a lower rate of return, but this assures at least the minimum return rate. Okay. So, if your manager finds out that their strategy, their allocation of fixed income is actually not returning what they thought it should or would, great play by Darth Maul, thought it should or would, they're going to have to go into the safest credit ratings they can get, just to kind of make up the difference to a certain degree, which makes sense. I mean, you're playing from behind. You gotta get a field goal at least. You gotta get some points back. Way to go, Darth Maul. Management tenure. When looking at the performance of an asset manager over many years, a key factor is the length of time that the investment advisor has been managing assets. Typically, a long-tenured advisor who has produced good investment returns can be expected to do so in the future. Investment advisors with a short tenure do not have a proven track record, and if there is a change of an investment advisor, this can be a red flag to potential investors because the new advisor does not yet have a track record. A final factor to consider when selecting equity securities, step 4, is whether to bias the selection based upon growth or value. Growth investing. Growth investing is the selection of equity investments based solely on earnings growth of stock price or stock price growth over time. Growth investing ignores fundamental and technical factors when selecting securities. Instead, if earnings growth or stock price growth is expected to outpace the market sector, then investments in these securities should produce superior returns. Think Tesla. Of course, the methodology for choosing these superior investments, superiors in quotes, by the way, is the key to the success of such a strategy. And since it is based on historical data, it is not necessarily predictive of the future. As with all such predictive strategies, it tends not to produce a superior result over a long time frame. Yeah, I didn't think so. Didn't think so. Did not think so. Alright. If we don't win this, I'm going to go ahead and switch the skin to our lucky blue, because I'm thinking the yellow is not doing it for me. The only time I want to see yellow is from the sun, you know. Let's do this thing. Let's get ridiculous. Oh, dude, don't even try me. Don't even try me. Fuck you. Value investing, price/earnings ratio, price/book ratio. Value investing is the selection of equity investments based on finding securities that are fundamentally undervalued in the marketplace. These tend to be solid companies that are currently, quote unquote, out of favor. Value investors look at such fundamental factors as the price to earnings ratio and price to book value ratio to find companies that are undervalued relative to their market sector. Then, by examining I hate when loud ass cars drive, man. Undervalued relative to their market sector. Then, by examining other fundamental factors, such as current products, new products, management, market share, industry outlook, etc., those companies that are expected to perform well over the coming time frame would be selected as quote-unquote good values. Over time, the market should recognize the fundamental worth of these companies and bring the pricing of these shares up to current market multiples. I would, and this is not in the book, but I would put the emphasis on the word should. The market should figure it out. That doesn't mean the market will figure it out. And it's going to take time for the market to figure it out, especially if you're in a bull market. It's easy to find undervalued companies when you're in a bear market because people say, what are the best stocks to put your company or put your money into so we can derive some value? You know, you're not going to put your money into a company that was a high flyer. All of a sudden it's not a high flyer. And what's your reasoning for wanting to invest in them again? Well, it went up before, it should be going up again. That's not what people are going to say. They're going to say, is this business, poised to return an adequate level of capital to its investors? If it is, invest. If it's not, we won't. So a lot of companies should be valued a certain way. And I agree, the market will eventually pick up on it. But, that eventually can take a long time, longer than most people are comfortable waiting as well. So that's a very, that's a big ask on an investor, on management. But I agree, there are lots of companies that should be better valued, and that's just a product of the market, right? Supply and demand. Some people just want what's popular and what works. Historically, some people are, they do their homework, but they don't really understand that what's in favor is going to outperform, and that's just the way it's going to be sometimes. Momentum investing will be the next section. Momentum investing is a type of technical theory. Momentum investors believe that the stocks that have prices moving at high speeds, either up or down, tend to continue moving rapidly in the same direction. That is, they have momentum, quote unquote. So if a stock price is moving up rapidly, just jump on the bandwagon by buying the stock and ride the price up. Of course, these stocks that have rapid price rises then typically crash and burn when investors become disenchanted with the stock. So the holder must get out before that happens. Yeah, that's market timing. That's a massive risk. Don't recommend it. But, that does play a massive factor in the market. People want what's new, what's trendy, what's sexy, what everybody else is buying into, and that's just FOMO. Momentum is a nice way of saying FOMO. So it seems here in the book. Oh, dude, what the? Okay, thought it was dead on that. That's Squidward. Oh, that's a beautiful Squidward. Okay. Momentum. What is the momentum telling you now? Oh, I almost overdid that. You're kidding, right? Whatever. Never claimed to be a good gamer. Also known as trend investing. Oh yeah, here we go. Whisper number. Momentum investors look for trend of earnings, surprises, either positive or negative, since these trigger, quote unquote, the herd investment behavior that underlies this theory. For example, if reported earnings are higher than the whisper number, the market's expected earnings, investors rush in to buy the stock, pushing the price up, creating the market momentum that underlies this theory. So the whisper number is, hey, what are you hearing, right? What are you hearing this is going to be? What are you hearing Apple's going to report? What are you hearing Google's going to have on revenue? Blah, blah, blah. Okay, I hear them. Funding techniques. Once the 4-step process of portfolio creation is completed, the actual funding of the portfolio must occur. That is, when is the right time to buy the selected securities? This comes down to the issue of market timing. One can create a balanced portfolio that meets the customer's objectives. But if the purchases are all made at the same time, just prior to a market crash, then the portfolio's return may be compromised for years to come. Of course, if all of the purchases are made at a market quote-unquote bottom, the opposite is true. The portfolio's return will be enhanced for years to come during the ensuing bull market. Lump sum funding. What was just described is lump sum funding of the portfolio. This should only be used for customers who have a very high risk tolerance, right? Yeah, those people are definitely taking the plunge with their money. That's a big risk, but big risk, big reward sometimes, right? So some people are okay with that, some people aren't. I recommend a good healthy balance. Have a little bit of that in you, but not too much that it's gonna, cost you the shirt on your back. Dollar cost averaging, DCA. A better way to fund the portfolio is to spread out the funding, say over the course of a year, in 12 monthly installments. By doing so, if the market takes a sharp drop during the funding period, only part of the investment will be subject to the market decline, whereas the rest of the investment will be made at depressed prices, so that on average, the dollar cost of the investment may be somewhere between the worst and the best cases that are provided by lump sum funding. This funding technique is called dollar cost averaging and is widely used to reduce volatility of returns. Yeah, you spread out the pain, the damage, the glory. You spread it all out. Makes sense. Ooh, wait, now I was gonna change the skin. Let's get out of here. Let's go ahead and do that. I got a new color today. Let's see if any of these patterns go with it. Oh, dude, what? All right, this one's in the lead right now. This is in the lead. Let's see. That's okay. It's all right. Oh, wow. That's nice. What's the one I have right now? Yeah, that one. That one is eye popping, if you will. I like that. Should we go French? Let's go French on him. Yeah, let's do something red in honor of the face. I like that. I don't like the face. That's good. Okay. Dollar cost averaging advantages. Another advantage of dollar cost averaging of common stock purchases is that when stock prices are depressed, correspondingly more shares are purchased, while when stock prices are high, correspondingly fewer shares are purchased. When done over a long time period, this buys more shares when prices are low and fewer shares when prices are high. Buying low is a proven way to make money over time, although mathematically, since more shares are bought when prices are low and fewer shares are bought when prices are high, the weighted average cost per share is always lower with dollar cost averaging than the pure mathematical average price per share over the same time period. Makes sense. Makes sense. Typical buy low. And also, my position on this is the more accumulated shares you have in something, even if it goes down, you're just collecting more compounding shares to be able to benefit from an uptick, an upturn, a bull market, if you will. The more shares you can get, the better. Obviously, that's easier said than done, but it doesn't have to be so big bet, big reward. It could be a process, especially during, times like today where the market is at depressed levels relative to its peak. Even though this might be a slowdown, I wouldn't go against throwing more money than usual into the market, a Vanguard index, so to speak, or something of the sort, because it's better to get more shares. I agree. I completely agree with this. The next section will be funding time frame, used most often for mutual fund purchases. All right, what game is this? Remember the number and fruit? Dude, look at my skin. I'm so cool. Look at all these losers. I think they're cool. That cowboy hat looks stupid on you, dude. All right, 3 reds, 1 green. I don't know what those reds are, and I don't know what that green is. Nobody should die here. Nobody should die here. Alright, 1 for 1. 2 bananas, 4 bananas, 1 pear, 1 orange. Okay, so 4 bananas, 2 pears. That is rough. That dude. Wow. Dude, get off. What's that? 3 bananas, 2 reds, 2 browns. Oh, 3 coconuts. 3 coconuts, 4 bananas. Might have been 2 reds, maybe 1, but it's the lowest. Nice job, okay. Funding time frame, used often for mutual fund purchases. Because common stocks are more volatile than bond investments, it is common to use 12 to 24 months time frame to fully fund common stock portfolios, but only 3 to 9 months in time frames to build bond portfolios. In reality, DCA is most often used with mutual fund purchases because investing the same fixed dollar amount periodically in mutual funds buys both full and fractional shares. Okay. Oh man, we are off to a bad start here, aren't we? Oh, we are not looking good here, man. Okay, so we need to get on it. Okay. Alright, so we got an 8 banger to start. Mine. 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 Come on, get me there. Get me there. Get me there. Mine. Alright, this has to be a perfect one. Oh, it's not. Get me there. Get me there. No way. No way. No way. No way. No way. No way. Oh, I don't come on. That's rough. Too bad I don't care about the game. There we go. Okay. DRIP. Dividend reinvestment plans. Another way for a customer to fund stock purchases is via a DRIP, which stands for a dividend reinvestment plan. These are plans offered by corporate issuers that give shareholders the ability to reinvest cash dividends paid by the company in additional shares of that company. This is a feature similar to automatic reinvestments of dividends at NAV, net asset value, in a mutual fund. There is no commission charged on reinvested dividends, and fractional shares can be purchased. The issuer's DRIP allows the shareholder to buy an increasing position in that issuer stock over time in a passive fashion. Because additional shares are purchased periodically with the reinvested dividends, this is a form of dollar cost averaging. The disadvantage of a DRIP is that the investor cannot determine the timing of these incremental purchases. You can't determine the timing, but you can determine whether or not you do it. So I'm a big fan of these, actually. Is that frozen? Anyways, I'm a big fan of DRIP. You can get a lot more shares for your money, and you really don't have to think about it. Sometimes if you just have DRIP on, you won't really know what kind of numbers you're building up in your account, and that's really the name of the game. You don't just want your money to be making the money. You want the company's money to be making you money. And if you can do that, I mean, wow, accumulate as many shares as you can, especially during a downturn. That would be phenomenal. So, it's a great strategy, I think. And that's it for that section. That was a quickie, but very effective. Sorry I couldn't win a Fall Guys game, but I don't care about the game. I care about the reading. Thank you.